And before I get into what I think is going to happen with crypto, I, in my opinion, think that the Fed is making a colossal mistake cutting rates at a time when the US government is printing and spending as much money as they ever have in peacetime, when you have inflation above their target, and you have real GDP growth of plus 2% for the past probably 8 to 9 quarters. And so while I think a lot of people are looking forward to a rate cut, meaning that they think the stock market and other things are going to pump the jam, I think the markets are going to collapse.
Hayes opens by highlighting a key chart from Bloomberg, which projects the market's expectations for future Federal Reserve rate cuts. According to Hayes, the Fed's decision to cut rates, while anticipated by many, is a colossal mistake, especially in light of the U.S. government's continued aggressive spending. Hayes explains that cutting rates in an environment where inflation remains above the Fed's target and GDP growth has been consistently strong creates an unsustainable imbalance. While investors might expect a boost in asset prices, Hayes warns of an impending collapse, particularly in the currency markets. He uses the example of the US dollar's recent performance against the Japanese yen to illustrate his point. A narrowing interest rate differential between the US and Japan could trigger another wave of financial stress. A similar market reaction is likely to follow if the Fed proceeds with rapid rate cuts, causing a liquidity crisis that would ripple across global markets.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Here's a chart I've referenced a few times, a global panoramic of which central banks are cutting, and we're about 50%. But the one that really matters is the Fed. What are they going to do? As of August 23rd, I think it was, this year, Powell got up in Jackson Hole and he proclaimed that it was time to cut rates. And as we can see here, this is a chart from Bloomberg which shows the market's expectations for how many rate cuts there's going to be from now and until the future. I haven't checked this morning, but I think it's about a 60 or 70% chance that they do a 50 basis point rate cut. And before I get into what I think is going to happen with crypto, I, in my opinion, think that the Fed is making a colossal mistake cutting rates at a time when the US government is printing and spending as much money as they ever have in peacetime, when you have inflation above their target, and you have real GDP growth of plus 2% for the past probably 8 to 9 quarters. And so while I think a lot of people are looking forward to a rate cut, meaning that they think the stock market and other things are going to pump the jam, I think the markets are going to collapse a few days after the Fed cuts rates, because this is going to narrow the interest rate differential between the US dollar and the Japanese yen. And we saw what happened a few weeks ago when yen went from 162 to about 142 over about 14 days of trading. That caused almost a mini financial collapse. And now if the Fed and the market expects that they're going to continue to cut rates very quickly, we're going to see a revisit of that financial stress. But back to crypto. So first up, Ethereum. A lot of you in here are probably like, what the fuck, Ethereum? We haven't done shit. Solana's just kicking fucking ass for the past few months in this bull market. The major narrative around Ether is that it's an internet bond. And so if it's an internet bond with a yield of 4%, then the T-bill yield is higher than that. Why would I invest in this bond? But if the T-bill yield drops quickly, which I believe it will, then Ethereum becomes in the money. And I'm earning more in endogenous Ethereum yield than I can get in US dollar yields and T-bills. And so as we see rates quickly decline, as I expect, because the Fed is going to cut rates, markets are going to tank, and then they're going to say, well, let's do more of that because that's what's going to fix things. We reignite the Ethereum bull market. So right now, as you can see here, the horizontal line is sort of the T-bill yield, and our staking yield in ETH is 3 to 4%. It's not doing enough for holders, which is why they don't own it. And as you can see here, Ethereum has underperformed Bitcoin in a very big way, this bull market that we've had year to date. Etherfi, which is a way that you can stake your ETH in a non-custodial way, has also gotten the shit kicked out of it. Because again, it's offering, I think, about a 3% yield after fees. That's not cutting it. We need the T-bill yield to fall faster. All right, so this is one of my favorite trades in my non-crypto portfolio. I just sit on my fucking T-bills and I collect fat interest. So this is the 1-month T-bill rate, and it's been hovering around 5.5% for the past year and a bit since the Fed stopped raising rates. Now, when you have enough capital and you make 5.5% on your money, you don't have to do very much. Why take risk? Why try to make your capital appreciate at the risk of capital preservation? And so when people would have a lot of assets, they are dissuaded from doing certain things because they can make so much money just sitting on their ass in T-bills. And this has had a profound effect across financial markets, including crypto.
Another project Hayes mentions is Pendle, an interest rate derivatives protocol that offers fixed and floating interest rates on assets like Bitcoin. Pendle recently introduced a Bitcoin staking product with a 9% yield, which Hayes notes is an attractive option compared to T-bills. However, he cautions that DeFi risks and smart contract vulnerabilities may deter more conservative investors.
So I want to lay out a few winners and losers from a change in the interest rate environment based on falling T-bill rates and interest income that you can generate just by owning the safest fiat asset that you can. So the first 3 assets here, Ethena, Ethereum, Etherfi, Pendle, just a disclosure, I own big-ass bags of these. I don't own any of Ondo, thankfully. But at the end of the day, the Maelstrom portfolio is very geared towards a falling interest rate environment. And basically what that means is we're long a lot of projects that give users interest income in various shapes and sizes. Now, right now, these income yields are either slightly above or below the rate of T-bills, and that has put a drag on their price performance. Because why would you invest in a riskier DeFi application when all you can do is call up your broker and put your money in T-bills and make 5.5%? Now, there are projects that have done very well in this high interest rate environment. I'm just using Ondo here as an example. There's lots of other real-world assets types of projects, and basically these are projects where they say, hey, you need treasury bills, we're going to buy them, put them in some sort of legal vehicle, and issue a receipt that pays you interest. These are one-way bets on rates going up and staying high, but when rates go down, there's no real need to have these products anymore. Next up, Ethena, a synthetic dollar. Again, this is a way to package a basis trade. For those of you who aren't familiar with it, I take some Ethereum, some Bitcoin, and even Solana physically, and I sell a perpetual swap against it, and I earn some yield. Why is this yield present? Because traders use leverage, and they have to pay for this leverage. And this trade has been going on for many, many years. This is how I started my career in crypto, trading this basis trade. Ethena has packaged this up in a very nice and easy way. You just stake your money, and you earn this yield. Again, there's risk involved. It's not exactly as safe as a US Treasury bond if you're a particular yield-chasing investor. And so if the yield that Ethena is offering is not that compelling versus a T-bill, you're not going to put your assets on this protocol. But again, if the T-bill yield and the Fed continues to cut rates, number one, crypto markets should reignite and go higher. Traders might expect that and pay up for leverage. Basis increases, TVL goes into Ethena, and hopefully the price exits the nuclear bear market. Here's a chart of the Ethena staked USDE yield versus the T-bills. As you can see, back earlier this year, this is very, very compelling. You're earning 30, 40, 50, 60% per annum versus a 5.5% T-bill yield. Of course, I'm going to put my dollars in this product. But right now, it's barely yielding at the T-bill yield. I think it's about 4.5% right now, so it's actually below. And as a result, Ethena's price has gotten hammered because people are saying, why do I want to put my money in this protocol when it's not giving me the yield that treasury bills are giving me? Again, If rates go down, this trade becomes attractive again, and TVL should rise, and so should the price. Another thing that we want to talk about, Bitcoin staking. Pendle is an interest rate derivatives protocol that allows you to trade fixed and floating interest rates. They've just rolled out a new product that allows you, through the Lombard Corn protocol, to essentially stake your Bitcoin and earn a fixed yield. And again, this yield is attractive, but it comes with risks. I don't think it's high enough yet to convince a lot of people to rush out of earning 5.5% in treasury bills into this Bitcoin yield. And I'll show you in a second what that yield is. Similar sort of story. If the yield drops, I'm more incentivized to own this sort of interest rate risk. And as such, the Pendle TVL, or total value locked, should rise and offset some of the TVL losses that are coming from the expiration of liquid restaking protocols like Eigenlayer and their points programs. Again, you can earn about 9% doing this strategy right now. It's quite a new thing. I think they just rolled it out a few weeks ago. You can earn 9% on your Bitcoin. Is it that attractive versus 4.5%? Maybe for some of you, but I would bet, given the DeFi risks and smart contract risks, that a lot of interest rate sensitive investors don't think this is high enough. But again, I can make 5.5% in treasury bills. So here's a chart of Pendle. It's obviously given back 50-60% of its gains so far. Will there be a resurrection as Bitcoin staking yields are outpacing treasury bills by a large margin? So I've spoken a lot about how I think real-world asset protocols are complete dog shit. And mainly that's because it's an interest rate bet. And I can do that in a cleaner and cheaper way than paying up for some high FTV, low float token. But at the end of the day, these protocols provide a valuable service. For those of you who don't have a US brokerage account or don't have access to one, it's very difficult to get a clean way to invest in treasury bills.
Hayes expresses his skepticism toward real-world asset protocols, RWAs, which attempt to bring traditional financial assets like treasury bills onto the blockchain. He describes these projects as dog shit, arguing that they are simply an inefficient way to bet on interest rates. Investors, he says, can gain exposure to treasury bills more easily and cheaply through traditional means without needing to deal with the added complexity and risks of blockchain-based RWAs. While Hayes acknowledges that these protocols may serve a purpose for individuals who don't have access to U.S. financial markets, he remains unconvinced of their long-term value, especially in a falling interest rate environment.
Please like and subscribe my channel.